So, a very good evening, respected IPs, distinguished guests, and dear friends. I am Namrata Randeri from IP.net, and it is my great pleasure to welcome you all to today's webinar on IBC 2016 Explained, which is Asset Wise Corporate Resolution and Winter Session Takeaways. We are honored to have with us Mr. Advait Darat, who would be speaking about understanding asset wise resolution of corporate debtor under IBC 2016. Sir, your presence here adds immense value to our learning community. And also, we have with us none other than Mr. Udairaj Patwardhan, sir, Regional Head, IP.net West, who would enlighten us on the key recommendations of the winter session. This is the 65th webinar in our series under IP.net, which is our platform dedicated to strengthening our professional capability and well-being through shared knowledge. Without further much ado, I invite Mr. Udairaj Patwardhan, member of the National Executive Committee and Regional Head of IP.net West, to deliver the welcome address. Sir, over to you.
Thank you, Namrata. I welcome you all to this 65th webinar. And the topic today is little different, is asset-wise corporate resolutions. And of course, we will touch upon the winter session takeaways. That asset-wise corporate resolution is going to be a truth that we will have to deal with after the amendment bill is approved. But even today, we have enough jurisprudence to discuss with. And today we have the who will be guiding us through that. You are all welcome to engage into the question and answers also throughout the session. I thank Dr. Matkija for leading as a president of IP.net, and we have been able to support the community through expert-led learning initiatives, practical guidance, and a dedicated member portal. So I hope you have been visiting our portal time and again, and you all have been very interactive in the group as well. So with this brief opening, I hand it back over to Namrata.
Thank you, sir, for the warm welcome and insightful start. Now I will play a short video that showcases IP.net's purpose, initiatives, and contributions.
IP.net, India's professional network for insolvency excellence. Because every insolvency professional deserves a voice, a community, and a platform to grow. Building a united, progressive community of insolvency professionals, driving excellence across India. Every week, every topic, every insight, together. Led regionally, united nationally, ensuring every voice is heard. Together, we shape the future of the insolvency profession. Your personalized space for learning, networking, and growth, free for every member. Be part of the mission. Be part of the revolution. Be part of IP.net.
Thank you so much for watching. Now to introduce our esteemed speaker for this evening, I request Ms. Gauri Deshpande to come forward and introduce CA Advait Darat.
Am I audible?
Yes.
Ma'am?
Yeah.
Okay. Today, it's my privilege to introduce CA Advait Dharap. He is a fellow member of the Institute of Chartered Accountants of India. He is also a information systems auditor. He has completed that course. He is also a certificate holder in Insolvency and Bankruptcy Code 2016. He is practically and actively engaged in the IBC work from 2019, and he has been dealing with more than 25 cases of CIRP process. Amongst them are some listed companies, which includes Silver Rock Commercials Limited and Maruti Cortex Limited also. Other prominent work of CIRP cases are DSK Motors Private Limited and Nicomet Industries Limited. He is in this practice from 2019, and he also provides the litigation support under IBC, and also has some practice areas like bank audits and concurrent audits, projects financing, and apart from the direct and indirect taxation. And today he is here to deliver a speech on the asset-wise resolution in CIRP process under IBC 2016. I welcome Advait Dharap sir to IPNet and request him to start his subject. Thank you.
Thank you, Gauri ma'am, for your kind words. So, first of all, I would like to thank IPNet for providing me the platform. Dr. Ashish Makhija sir, the president of IPNet, and CA Udairaj Patwardhan sir, regional director West Region, for giving me this opportunity. So, I would like to begin with saying that, as Udairaj sir mentioned, that asset-wise sale is one of the areas which is being looked into in this amendments, and that we will look into in the topic when I cover. So that is one thing. But having said that, there are already cases which have taken place. So I'll just begin with my presentation. I hope my screen is visible to everyone.
Yes, it is visible.
Yes, visible.
Yeah. So basically, the today's topic is understanding asset-wise resolution of corporate debtor under IBC. So what this topic is and where this came from, I would like to begin with a short history on this matter. So this began with a 30-second report of Standing Committee of Finance, which was discussed in August 2021, based on which there came a discussion paper of IBBI in June 2022. Based on these recommendations, the CIRP regulations were amended in September of 2022, which gave way to asset-wise sale of or asset-wise resolution of corporate debtor. And now, accordingly, there have been 4 cases, to my knowledge, 3 or 4 cases, wherein asset-wise resolution has taken place. Recently, there has been an amendment in CIRP regulation in 2025, May of 2025, which has changed the process of going for asset-wise resolution. And now in the amendment bill which is proposed, so there was the report of select committee which has again harped on this subject and has proposed further changes in this asset-wise process. So beginning with the problems identified, the Standing Committee of Finance, in its 30-second report dated 3rd of August 2021, it observed that the Section 526 of the code defines a resolution plan as a plan proposed by a resolution applicant for insolvency resolution of the corporate defaulters as a going concern. Resolution professionals, COC, and certain orders of NCLT indicated that the term going concern implies that the plan must result in the disposal of entire business and operations of the corporate debtor under one plan. So basically what they felt is that the ecosystem is considering that a plan should deal with corporate debtor as a whole, whereas maybe the intent of the legislative intent behind the code or the thinking behind the IBC was not so restrictive. So, in their actual experience, it was shown that bidders may be interested in selected business units or assets rather than entire business. A combination of bidders taking different business units or assets may well be far superior to one bidder acquiring the entire business from the COC. However, the resolution professional does not currently have the flexibility within IPC to dispose of the corporate defaulter across multiple bidders. Regulation 37 does allow the RP much flexibility in developing a plan across multiple bidders, each taking different piece of corporate debtor. Regulation 37 of CIRP regulation permits transfer of all or part of assets to one or more persons and sale of all or part of assets as a resolution plan. So basically, in the legislative intent, it was always there that what the plan can be is a very dynamic thing. It need not be restricted to a corporate debtor as a whole or how we envisage a plan to be. It can be a very dynamic thing based on case to case basis, was the legislative intent. And that was reiterated by the committee that if we stick to going for a just corporate debtor as a whole, then we are restricting the possibility of getting plans in large units or large companies where there may be some part of the company for which there is a bidder and some part which may not be resolvable. So, in conclusion, they recommended that an amendment should be introduced to allow asset-wise sale for the corporate debtor. So, this is where basically the first discussion takes place about asset-wise sale. Accordingly, the IBBI brings out a discussion paper on 27th June 2022, and it again goes on similar lines with what the standing committee had observed, that either we have situations where all the assets are resolved, or the corporate debtor as a whole goes into liquidation just because there may be some parts of the corporate debtor or some assets of the corporate debtor which are not viable due to economic considerations or due to some litigation or title documents or any other problems with that specific asset. The company may be having 3, 4, 5 total assets, and out of which one or two asset may only be bad apples. But because of these two bad apples, all the remaining 2, 3 other assets which are good in nature, they also get dragged into liquidation, and that in totality brings down the resolution or the amount which is realized for the stakeholders. So this was observed that CDs having both functional and non-functional assets or assets across varied location or in different businesses in country, so that are not getting resolved properly. PRAs are interested in functional asset or asset in one location or business and is not interested in the other. Additional investment demand for non-functional asset or asset becomes too high, and hence the PRA is not willing to put in a resolution plan. Large conglomerates were being pushed to liquidation because no single buyer wanted the entire basket of assets or liabilities. So, looking into this scenario, there was a philosophy shift from moving from corporate debtor as a whole to value maximization via assets. So now we have a situation where you can have either company as a whole or you can go for separate units or separate assets. This introduced a multi-stage approach to allow different buyers for different business verticals. So how this was brought about was that since CIRP regulation provide for reissuance of RFRP, the RP and the COC could explore the resolution for part assets or business sale by allowing submission of different resolution plans, and accordingly the evaluation matrix can be amended. So this, after this discussion paper, the amendment were introduced in September of 2022 by Insolvency and Bankruptcy Board of India, Insolvency Resolution Process for Corporate Persons, Fourth Amendment Regulation 2022. So with this amendment, what they did was that after Regulation 36B, which deals with issuance of RFRP, 36B, sub-regulation 6, they introduced the sub-regulation which stated, sub-regulation 6A, that if the RP does not receive a resolution plan in response to the request under this regulation, he may, with the approval of the committee, issue request for resolution plan for sale of one or more assets of the corporate debtor. Further, they introduced after Regulation 36, Subregulation L, the following regulation, Subregulation M, sale of one or more assets of the corporate debtor to one or more successful resolution applicant, submitting resolution plans for such assets and manner of dealing with remaining assets. So now we have a situation that, excuse me. So now we have a situation that if a resolution plan is not received or the RFRP fails, then the resolution professional has the opportunity to reissue request for resolution plan, in which he can provide an option to the resolution applicants to submit plan for one or more assets of corporate debtor. Again, this is a voluntary thing which can be done with the approval of COC in their commercial wisdom, and how the assets are to be selected, that is also to be dealt with by the committee and the REs in their plan. So then the legal framework after this amendment was that, as per section 5 subsection 26 of the code, resolution plan was defined as a plan proposed by resolution applicant for insolvency resolution of the corporate debtor as a going concern in accordance with part 2. Explanation to this subsection states that for removal of doubts, it is hereby clarified that a resolution plan may include provisions for the restructuring of corporate debtor, including by way of merger, amalgamation, and demerger. So if we look at this explanation, it very explicitly and clearly states that a resolution plan can be in a way that the corporate debtor is restructured by way of merger, amalgamation, and demerger. Now, here we have to focus on the demerger part of it, because if we are going for asset-wise sale, then what is happening is that a specific asset or a specific unit of the corporate debtor is being removed from the corporate debtor and being taken over by the resolution applicant in the resolution plan. So in a way, this deals with the demerger part of it. So this provision allows for the possibility of asset-wise sale of corporate debtor. And then this is further to be read with CIRP Regulation 36B6A, which was introduced, that if the RP does not receive a resolution plan in response to the request under this regulation, he may, with the approval of committee, issue RFRP for sale of one or more asset of corporate debtor, and Regulation 37M, which allows for sale of one or more assets of corporate debtor to one or more RAs submitting the plan. So now we have a situation where the code allows for demerger. The regulations specifically allow the COC to sell one or more units of the corporate debtor. And also there is a provision in the Regulation 37 wherein the plan can have a provision for sale of one or more asset. So this is how it was going on till very recently. Then in February 2025, again, a discussion paper came out from IBBI, which dealt with, among other things, it dealt with streamlining the streamlining processes under the code. And in that, what they observed is that the current regulatory framework under 36B6A of the CIRP regulations mandate a sequential approach where the RPs can invite plan for sale of one or more assets only after failing to receive the plan for entire corporate debtor. So as we have seen previously, that 36B6A is very clear that it can happen, asset-wise sale can happen only when you have not received plans under the 36B issuance of RFRP. So this was a sequential approach, and the regulator realized, we can see, we'll see this from the upcoming judicial pronouncements that are also there, that in all the cases, what was happening is that firstly, the Form G was issued, then maybe another Form G was issued, or RFRP was issued, then a 30-day mandatory period required for submission of plan was granted. Maybe that period got extended. So around 30, 40, 60 days were wasted and there was no outcome. The CIRP period used to get over, the COCA had to go for an extension. And subsequently, the COC, although if the COC previously realized at the very beginning that the corporate debtor as a whole may not be resolved, still they had to go through this process, and then they could come out and say that since we have not received the plan, now we will be going for asset wise sale. So this came to the notice of the regulator, and they rightly highlighted this point, that it is observed that this sequential requirement may lead to extended CIRP timelines. This restriction may also result in viable business segment losing value while waiting for the sequential process to complete. Because if you're wasting the 60, 70 days in just waiting for the time to get over, then you are losing value. This is particularly challenging in cases of complex businesses where different segments might attract different types of investors with specific expertise and interests. So this is what they discussed. So what they proposed is that to amend Regulation 36B to allow resolution professionals with COC approval to invite resolution plans concurrently for both the corporate debtor as a whole and for specific businesses or assets of the CD. So this proposal removes the requirement that RPs can only seek asset-specific plans after attempts to invite a resolution plan for the entire corporate debtor have failed. By enabling concurrent invitations, the resolution process can reduce timelines, prevent value erosion in viable segment, and encourage broader investor participation. So, as this was discussed, accordingly, the amendment came in May 2025, which was the Insolvency and Bankruptcy Board of India Insolvency Resolution Process for Corporate Persons, Fourth Amendment Regulation 2025. So, with that, they made a change from from a sequential model to a concurrent model. So how that was brought about is that after Regulation 36A, subregulation 1, the following subregulation was inserted. So 36A, which deals with issuance of invitation for expression of interest, Form G. In that, they inserted that subregulation 1A, the RP may, with the approval of the committee, invite expression of interest for submission of resolution plans for the corporate debtor as a whole, or for sale of one or more assets of corporate debtor, or for both. And the regulation 36B6A was omitted. So with this, they have now made it such that in the first instance itself, the COC can identify the assets, and they can take their commercial call that whether in a case you have a corporate debtor getting resolved as a whole, or you may have identified assets, some of which are good, some of which are bad. And then you give the opportunity in the first instance that, yes, you can submit plan however you deem fit. So now we have the revised framework after the recent amendment is that as the section 5 subsection 26 remains the same, which allows for the explanation which allows for restructuring of corporate debtor by way of merger, amalgamation, and demerger. Now you have a scenario where regulation 36A1A allows for calling for invitation for expression of interest for corporate debtor as a whole or for asset wise. And again, 37M remains the same, that sale of one or more asset may be proposed in the resolution plan. So this is what is the legal scenario right now. All the cases that so far have been dealt with by NCLT were previous cases before this amendment. So in all cases, 36B sub regulation 6A was the basis of which the plans were approved. To my knowledge, this recent amendment has not yet been implemented in any plan. Maybe there may be some plans in pipeline on which the voting will take place. The plan will be put forth before NCLT. But as of now, no plan has been approved in this revised regulation. So now the question arises that there is one more provision in the CIRP regulation which deals with sale of certain assets outside apart from corporate debtor as a whole, but certain sale. So this regulation 29 of CIRP regulation, this has been also in the regulations for since beginning. So this regulation states that the RP may sell unencumbered assets of the corporate debtor other than in ordinary course of business if he is of the opinion that such a sale is necessary for better realization of value under the facts and circumstances of the case, provided that the book value of all assets sold during corporate insolvency resolution process period in aggregate under this subregulation shall not exceed 10% of the total claims admitted by the IRP. Subregulation 2, sale of assets under this regulation shall require the approval of committee by vote of 66% of voting share. And subregulation 3, a bona fide purchaser of assets sold under this regulation shall have a free and marketable title to such asset, notwithstanding the terms of the constitutional documents, etc., etc. So basically, what this is, it is different from what we have seen so far. This talks about specifically unencumbered assets. So there are two restrictions in the regulation 29. Firstly, that the assets being proposed to be sold under sub-regulation 29 are unencumbered assets. So there is no such requirement in the asset-wise sale under 36A, 1A. And second part is that the assets sold under this sub-regulation cannot exceed 10% of total claims. So basically, this regulation talks about minor other assets of the corporate debtor, which may be in the nature of, for example, some cars which are owned by the corporate debtor, which are not relevant to the actual business of the corporate debtor. Maybe some director's cars are there, or maybe some investments, 5-10 lakhs investments are here and there somewhere in some other companies or so. So this regulation 29 deals with other assets of the corporate debtor out of the other than ordinary course of business. So that is what is important in this. Whereas when we talk about sale asset-wise resolution of the corporate debtor, we are talking of business verticals. We are talking of some assets, maybe in a real estate company, it may be certain projects, or maybe some unit which is in different locations. So in asset-wise resolution, there is no such limit about encumbrances, about any percentage of debt or anything like that. It can be it is for the COC to decide and take a call that what assets are proposed to be sold. So that is the main point of distinction between regulation 29 and asset-wise sale in regulation 36A, which was previously in 36B 6A. So now we come to the judicial pronouncements. As I mentioned, there are 4 cases which have so far dealt with asset-wise sale, and I am happy to announce, or I am happy to declare that I was fortunate enough to be part of one of that case. So before going to that, I'll just give you a short brief of the case which personally I dealt with. That was a case wherein there were 3 units of the corporate debtor having separate locations, and we were able to get plan for 2 units. The third unit, there were no taker due to the geographic constraint and some local issues at the site. So accordingly, we were able to get the COC approval, and then the plan got approved, and the third unit along with the corporate debtor went into liquidation. So that is also one of the case that we'll be looking into today. So to begin with the cases, the very first case, which is the landmark case in this asset-wise sale, because this was the very first case which happened in IBC mechanism, is CA M. Suresh Kumar of RP of Hindustan Photo Films Manufacturing Company Limited. This is from NCLT Chennai bench, order dated 31st March 2023. So the facts of the case are that the company was admitted into CIRP wide order dated 7th of January 2022 on an application filed by Canara Bank Financial Creditor. The RP prepared a request for resolution plan and evaluation matrix, which was approved by the COC in third COC meeting held on 6th of May 2022. During the meeting, the IM was also shared. So the corporate debtor had the assets which are given below. Land and building. There were 4 land and building. The 2 leased lands, 200 acres and 90 acres, and 2 freehold land of 12.19 acre and 4.49 acres in Ambattur. There were plant and machinery, Unit 1, Unit 2 in Ambattur, 3, Unit 4, and there were some stock and book debts. So the RP in the fourth COC held on 6th of June 2022 informed that no plan has been received and that 2 PRAs had sought extension of time for submission of plan. He further, he further informed that some parties are interested to take over Ambattur property for outright sale, but till date, no party has shown interest to revive the corporate debtor through plans, since the UT properties of the corporate debtor are leasehold land allotted by Forest Department and litigations are pending on the same. The COC, considering the facts, approved to reissue EOI for revival of the corporate debtor. The RP republished Form G on 27th of June 2022. In pursuance of the same, 2 applicants submitted their resolution plans. The plans were presented before the COC in the 8th meeting held on 6th of October 2022. In the 9th meeting on 15th of October 2022, the revised resolution plan submitted by the RAs were discussed in detail. A resolution plan of one of the applicants was disqualified due to non-submission of EMD, which was a prerequisite. So now we have a situation that there was only one plan, compliant resolution plan. The resolution plan of the other RA proposed acquisition of assets through a scheme of arrangement, that is demerger of part of assets of the corporate debtor, which is freehold assets. So as I previously mentioned, that in all these cases, you will observe that there is a demerger. Some of the assets of the corporate debtor which are to be acquired by the resolution applicant will be demerged from the corporate debtor and separately taken over by the resolution applicant, either in its own company, existing company, or in some SPV which is prepared. So that is what will take place. It was discussed that this is anyways available in the RFRP, which is a new insertion of Regulation 36B 6A. It was also noted that the resolution plan value, rupees 105.30 crores, was more than the liquidation value, 91.87 crores, for the 2 assets proposed to be taken over. So the demerger of 2 undertaking from the corporate debtor and vesting the same into 2 companies of the SRA through resolution plan, namely into SGS Land Holdings Private Limited, resulting company 1, and KIM RAM Exports Private Limited, resulting company 2, was proposed in the resolution plan and the application filed by the resolution professional. The rationale for the scheme was that in order to provide optimum value to the creditors, it was considered necessary to segregate and realign the assets of the corporate debtor. By demerging the verticals representing the demerged company and retaining the verticals of the remaining undertaking will have a positive impact on company's revival plan. Also, the demerged undertaking were located at 2 different districts in Tamil Nadu. It was advantageous to demerge to respective resulting company. So the compliant resolution plan was placed before the committee for consideration of COC in the 10th meeting held on 11th of November 22. The COC re-examined the plan in detail, and the said plan was considered and approved by COC members with 77.94% voting in its favor. The COC passed a resolution for part sale of assets of the corporate debtor through resolution plan, and remaining assets called as leasehold assets were to undergo liquidation. It was further resolved that amount allocated to the secured financial creditors, rupees 100.80 crores, shall be appropriated amongst the secured financial creditor as per inter se agreement of the financial creditors in the following manner. So the first charge holders were to get 70% and the second charge holders were to get 30%. Now, this is a very interesting point which was dealt with by the COC by an inter se agreement between the creditors. Because what happens is that in case when you are selling specific assets, then the question arises that how the amounts are to be distributed amongst the creditors. There may be some creditors which are directly having some interest in the specific asset being sold, financial creditors who may have charge over the assets or who may have specifically funded those assets. In that case, it becomes easy to identify the creditor, but it normally it is not so, because at the time the corporate debtor is operational and raising the debt, it is not envisaged that some assets will be sold. So you have a situation where the financial creditor is having charge over all the assets, or maybe some financial creditor are having charge over some asset and others are having charge over other asset with a secondary charge on the remaining asset. So all this becomes very complicated, and then how you distribute it, that becomes a challenge which is for the RP and the COC to decide. And this was a case where the creditors were able to arrive at a conclusion. But it normally, it is rare to find a scenario where the creditors may agree so amicably. So that is one challenge in this asset-wise sale, that how the distribution is to be processed. So with this, the Honorable NCLT approved this plan. They held that Regulation 37BA of CIRP regulation was inserted to imply that a plan can provide for merger, amalgamation, or demerger. So this is very interesting, is that in all the plans, because there is a demerger, there was a relief sought that whatever the requirement for demerger and then the subsequent merger with the RA company, so whatever the Companies Act requirement be dealt away with, be waived off in view of the supersedence provided to IBC, and be granted as a relief to the RA. So it was held that Section 230 to 232 and other relevant sections of the Companies Act need not be separately dealt with by the RA. They can become a part of the plan. He can seek waivers for the requirements of the Companies Act. So with that, the demerger proposal and the resolution plan was approved, and the corporate debtor was liquidated by a separate order. So now we move on to the second case. This is from NCLT Amravati bench, and this is for Seven Hills Healthcare Private Limited. This was passed by an order dated 10th of June 2024. So the corporate debtor was admitted into CIRP by order dated 13th of March 2018, passed by Honorable NCLT in an application filed by Axis Bank Limited, a financial creditor. The RP filed an application seeking approval of resolution plan for the corporate debtor. The same was approved by Honorable Tribunal by order dated 26th of July 2019. However, the same was eventually overturned by Honorable Supreme Court by order dated 15th of November 2019, which led to recommencement of CIRP. So now we have a situation that first CIRP took place, a plan was received for corporate debtor as a whole. It was approved by the COC, allowed by Honorable NCLT, but on appeal, it was overturned and the CIRP recommenced. Subsequently, Form G was issued twice, first on 13th February 2020 and on 21st of November 2020. Subsequently, in response, the RP received one plan. However, it was found to be non-compliant and hence not proceeded with. Subsequently, considering the fact that no compliant plans were received for the corporate debtor as a consolidated entity, the COC in its commercial wisdom resolved to invite expression of interest for separate category of assets as per Regulation 36B6A of CIRP regulations in terms of amendment dated 16th September 2022. On 6th of January 2023, the applicant issued fresh Form G, which was followed by RFRP dated 3rd of May 2023. The RFRP invited resolution plans under two categories. Category 1 was for Vishakhapatnam Hospital, and Category 2 was for Mumbai Hospital and corporate debtor as a whole, but specifically excluding Vishakhapatnam. So, in this case, what happened is that the Mumbai Hospital, there was some litigation going on with Brihan Mumbai Municipal Corporation. There was some dispute with the property title and other relevant things. So basically, when the original plan was also submitted for corporate debtor as a going concern as a whole, the municipal body objected to that plan for whatever their pending litigation was, and on that it was overturned. So the RP, in consultation with the COC, realized that for the Mumbai hospital it may not be viable because that litigation was going on. In fact, to my knowledge, from what I checked, the litigation regarding Mumbai hospital is still going on with the municipal corporation, although the plan for Vishakhapatnam hospital was resolved. So this is a very interesting case wherein the plan got submitted, approved by COC, allowed by NCLT. The plan was dealt with, but still the CIRP continued because the COC never resolved for liquidation. The CIRP is still going on till date. The litigation regarding the Mumbai property is still going on. So the RP received 3 resolution plan for Vishakhapatnam hospital because now he had called for 2 categories, Vishakhapatnam and Mumbai. The final revised resolution plan were submitted to COC on 8th of December 2023. In the 47th COC meeting, the 3 plans were put to e-vote, and one of the plans submitted for Vishakhapatnam hospital was approved by COC with 100% voting share. Subsequently, the RP submitted an application before Honorable NCLT for approval of the resolution plan for Vishakhapatnam Hospital, that is Category 1 asset. The plan was for an amount of rupees 171 crores, an outlay of 153 crores, which was proposed to be paid towards settlement of all creditors and statutory authorities. The resolution plan proposed for demerger of a hospital of the corporate debtor and vesting of the same into a company of the SRA. The application was allowed by the Honorable NCLT. The scheme of demerger, which was provided in the resolution plan, was approved. NCLT held that approval of the resolution plan shall constitute as an approval of plan under provisions of 230 to 232 of the Companies Act, which govern corporate restructuring. CIRP. So as I said, this is a very interesting case wherein one asset has been dealt with, it is over, yet the CIRP of corporate debtor with the remaining asset, that is Mumbai Hospital, and its litigation is still continuing. Pardon me. So now we move to the third case. This is from NCLT Delhi bench. Pallavi Joshi Bakru versus Universal Buildwell Private Limited, by order dated 7th of March 2025. So this CIRP of the corporate debtor was initiated by order dated 3rd of July 2018, passed by Honorable NCLT on an application filed by Ms. Pallavi Joshi Bakru, financial creditor. The RP submitted an application for approval of resolution plan as approved by COC. In the application for approval of plan, one of the dissenting financial creditors objected to the plan. Honorable NCLT found merits in the objection raised by the dissenting financial creditor and remitted the resolution plan to the COC for their consideration and necessary modification to make the resolution plan compliant. The 2 financial creditors of the corporate debtor preferred an appeal with Honorable NCLAT against the impugned order of Honorable NCLT. The appeal was dismissed with Honorable NCLAT granting one of the prayers of the appellant. Sorry, excuse me. Subsequently, the plan was modified by the RA in terms of order of Honorable NCLT. So, Honorable NCLT found in the original application that the plan was non-compliant with that in terms of Section 30 and Regulation 37 and 38. Some non-compliances were observed. So, the RA modified the plan and the revised plan was filed with Honorable NCLT. Again, there was a challenge, objection to the plan with regarding title over one of the asset, and also the financial creditors. Two of the financial creditors challenged the plans for compliance, stating that asset-wise resolution plan is not compliant with provision of the code, because they stipulated that when you did not have asset-wise CIRP, how is it that you are proposing asset-wise plan? Although this argument is very much devoid of merit, because we have clearly seen that you can have an asset-wise plan, but that was the argument that they made. So the plan proposed resolution for three projects of corporate debtor, and liquidation of the remaining project was proposed. So the objection was, as I mentioned, regarding how you can segregate these assets. But NCLT held that the objection is not maintainable. The part resolution and part liquidation is very much permissible. And NCLT held that Regulation 36B6A allows this to be done, and the plan was approved. So far that we have seen in the three cases, it is very interesting that only this one case was about a real estate entity and the projects which of the real estate entity. Previous two were of a non-real estate entity. So we can see that this asset-wise sale can apply to any entity. It is not so that it is to be done only for some project or some scheme. We can have it in any scenario wherein you have distinguishable asset having a clear demarcation or a clear situation where you can alienate the assets from the company, separate the assets from the company. So in that case, you can go for a asset-wise sale, irrespective of the industry or the vertical that the corporate debtor is engaged in. So now coming to the fourth case, NCLT Cuttack bench. So as I mentioned, this is the case in which I had the privilege to work in. I was very much involved in this case. Chandan Lal Sahu versus Ecomeister Beats India Private Limited, order dated 17th of October 2025. The corporate debtor was admitted into CIRP while order dated 15th of May 2023 passed by Honorable NCLT. In the second COC meeting held on 7th of June 2023, the COC approved publication of Form G, and accordingly the RP published Form G on 14th of June 2023. In the third meeting held on 16th of August 2023, the RP informed the COC that 7 PRAs have submitted expression of interest. However, the COC decided to republish the Form G to get more PRAs while allowing the existing PRAs to continue. Accordingly, the RP republished Form G on 24th of August 2023. In the fourth meeting held on 25th August 2023, the RP informed that total 9 PRAs have been included in the final list of PRAs. Further, the COC approved RFRP and evaluation matrix. So, to give you a background of this corporate debtor, this corporate debtor was engaged in business of slag removal. So, in large iron and steel industries, what happens is that when the iron ore is purified, you have certain slag which accumulates, which is a waste for the iron and steel industry. So the corporate debtor was engaged in removal and processing of the slags, having units at Bellary, Karnataka, Raigad in Chhattisgarh, and Angul in Odisha. So these units were situated within premises of large iron foundries, basically within the premises of the likes of JSW Steel, JSPL, and so on. So these large, wherever the iron ore refining takes place, within that, their activity was to remove the slag, process it, and dispose it off as per the whatever the MPCB, I mean the pollution control norms are there, it was to dispose it off accordingly. So in the sixth meeting of COC held on 30th November 2023, the RP informed that even after extending the last date of submission of plans, no plans have been received. And the RP informed that as per his discussion with PRA, there are some PRAs who are interested in 1 or 2 units of the corporate debtor, but there is no PRA willing to submit a resolution plan for corporate debtor as a whole. So you had a situation where the RFRP was issued. There was an extension granted for submission of plan, but despite having granted the extension, no plan was received. And then the COC, in its commercial wisdom, decided not to further extend. And then we had in detailed discussion, because from the feedback we received that as a whole there were no takers, but for some assets there was good value, for some units there was good value. So the COC took note of the same, and in 7th meeting held on 14th of December 2023, the asset-wise proposal was put forth, and the RFRP and evaluation metrics were modified in terms of Regulation 36B6A and approved by the COC. Then this RFRP was reissued because there was no fresh Form G, so there was no need to again call for PRAs and everything. We just went for a reissuance of RFRP, which is duly allowed by the code. And then the existing PRAs were given an opportunity to submit a plan for asset-wise sale. So in the 8th COC meeting held on 22nd January 2024, RP informed that one resolution plan has been received, which was opened before the COC members. The COC undertook negotiations with RA, and subsequently a revised plan was submitted by RA. So the plan was for 2 units of the corporate debtor, namely the Angul unit and the Raigad unit. There were no takers for the Bellary unit. So the revised resolution plan was put to vote in 10th COC meeting held on 10th February 2024. The COC with 100% voting share approved the same. Further, the COC resolved to liquidate the Bellary unit of the corporate debtor. So these 2 units were resolved, and the Bellary unit with the remaining corporate debtor was liquidated. So the application was filed with Honorable NCLT. Honorable NCLT held that part resolution and part liquidation is permissible. They approved the plan, and the corporate debtor along with the Bellary unit was liquidated by a separate order. So now coming to the challenges, because I have, as I mentioned, that because I had a personal experience dealing with asset-wise sale, so I can give a first-hand experience that what challenges that we faced in this asset-wise resolution is. Firstly, there is nowhere prescribed in any code or any regulation that what is an asset to be dealt with under the asset-wise sale. So it is for this RP and the COC. Although from our experience, we can say that the COC does not have that much capability or the bandwidth to decide upon the identification of assets. So the RP has to guide the COC that what can be, how the assets can be segregated in such a way that it can lead to value maximization. You can always go by any vertical segments if you have a clear-cut business. Like fortunately in our case, the units were very separate in 3 distinct geographies, having no inter unit activity or any inter unit transactions. So whatever was happening is in one state was very much limited. The vendors were separate, the assets were separated, the staff and the employees were separate. So it was very easy in that matter. Although the unit wise or asset wise balance sheet was not there, but still it was viable to segregate the businesses based on geography. It may not always be the case that geography is what separates the business. It may be that one business is in some vertical, one business is in other vertical. There may be a situation where the businesses are integrated in a way that they share some common assets. So then that is for the RP to decide and to form a plan or to form a proposal that how the assets are to be segregated in a way that uh, it will lead to value maximization. So identifying the assets becomes a very key point in all of this asset-wise sale, because if you do not plug the bad apples from the basket, you have a basket where you have 5-10 apples, 5-10 businesses, or 5-10 assets which can be sold. So of that, it is the job of the RP to identify the bad apples and to remove them so that the good assets can be realized and good value can be realized from those. So the challenge becomes to identify the assets. Then, as I mentioned, that normally the balance sheets or the books of accounts may not be in such a way that the assets are clearly demarcated in the books. So segregating at a balance sheet level, that becomes a challenge. Valuation of the assets. This is again a very critical aspect, because the code and the regulations are very much silent on this part, that how to value the assets in such a scenario. Treatment of claims and distribution under the plan. As I mentioned in one of the case, that the charge over the assets may be with different financial institution. Some may be having a pari passu, some may be having first charge, second charge. Some vendors may be common, some may be separate. So the distribution is a key challenge in this. And again, there is no framework or no guideline as to how you deal with the claims and the distribution under the plan. Treatment of secured financial creditor, treatment of statutory dues, and claim against the corporate debtor for remaining assets. So looking at the challenge, as I mentioned, that the bifurcation of assets is one key point in this. Then treatment of intangible assets. Now, if you have some intangible assets, then how you deal with it? When you have a corporate debtor as a whole, it is not an issue. But when you are segregating the assets, then how you deal with intangible asset, that becomes a challenge. Treatment of deferred tax assets and deferred tax liabilities. So this is also a challenge, because in tax laws there is no provision that the asset wise any taxation is done. Taxation always happens at a corporate debtor level. Then if you have deferred tax assets, how you deal with that, that is a point. Treatment of loans. Normally, loans are taken at corporate debtor level, at a company level. Maybe there may be some case where there is a finance for acquisition of plant and machinery. So if you have a specific case where the funding is very clear that the loan came in and it was for this specific purpose or this specific asset, that is okay. But when you have a project finance or a corporate debtor level working capital finance, CC you have, then in that case, how you identify that the loan amount went to which unit or to which asset, and how to apportion the claim amount, that is a key challenge in this process. Next, moving on to valuation of assets and units. So, in CIRP regulations 35, subregulation 1, clause B, it is stated that if two estimates of value in an asset class are significantly different, you can just look at this, or you can observe that it clearly says that estimates in an asset class. Now, when we say about asset class, land and building, plant and machinery, and SFA become the asset class. Now, when you see at a corporate debtor level, that is okay. We all are aware that when there is a significant difference, we go for a third valuation and accordingly deal with it. But now, when you are looking at a group of assets, so when the valuation is being done, it is for whole corporate debtor. So, if say we have a situation that the total difference is less than the 20%, 25%. So it is, say, for example, it is 15% difference between the plant and machinery category. But within that category, if you have a situation that plant and machinery of asset A, which is proposed to be disposed of, and asset B, so you have these two assets which are proposed to be disposed of in a plan. Now, in asset A, if you look at the plant and machinery, and that difference is, say, for example, 30%, and in asset B it is some other percentage. Then how you deal with, because regulation does not identify any distinction between these assets. So if we go by the literal interpretation, word to word interpretation, it becomes clear that we need not bother when the value difference in asset class is the same, is below. You can proceed, not an issue. But if we go by the spirit, I think it will be interesting to see how the courts deal with it, how the matter is dealt with when you have in within that asset a difference of more than 25%. So that needs to be looked into, or some clarity needs to come in. So this is one of the challenge. And then valuation of integrated units. So as I mentioned, that we may have a situation where you have identified one asset and you have identified, I mean, asset A and asset B. Now there may be some common assets. Say for example, there is some common gas pipe or some common water pipeline coming in, which may be valued at a good amount, 30, 40 lakhs, or maybe even 2 crores. Now, when asset A and asset B were working together, they were sharing this common asset. Now, when you have segregated these assets, how you deal with the valuation of the assets without this common asset? That is a challenge which I think is one which further clarity has to come in. Then treatment of claims and distribution under the plan. So as I mentioned that how you bifurcate the creditors and how you deal with the financial creditors, that becomes a task, because you have financial creditor who have charge over the all the assets. Normally in case of CCOD facility, working capital facility, you see a situation that all the inventories or all the receivables are having a charge, and then other assets are having separate charge. Then that becomes a very crucial thing, that when you are segregating differently, then how you deal with that and who gets paid what. That is a very interesting thing which has to be looked into. Then statutory dues, because as I mentioned that any statutory due is not or done on any asset level, be it direct tax, be it indirect tax, pardon me. So all the statutory dues, normally, apart from say property tax, is very specific, that will be related to any specific property. But the other statutory dues like PF, ESIC, income tax, GST, state tax, whatever other direct and indirect taxes, those are at a corporate debtor level. When you have a situation where only part of the assets are being disposed of, then how you segregate the dues and what payment you propose to dues, that becomes a very interesting thing. You have to work something out, is in such a scenario. Then pooling mechanism for pooling proceeds from multiple assets. So we have a situation that it is not necessary that only one asset is being sold. We can have a one or more assets. Say asset A is sold to one resolution applicant, asset B is sold to another, and asset C with corporate debtor is being dealt with separately. So then in such situation, what happens about the remaining claim amount? And also say for example that from asset A some portion is paid off for the vendors who provided to asset A, then whether their claims get dissolved, or their claims become null, or they have certain claim against the corporate debtor even after that, that needs to be looked into. So that is for which should be clarified. So this is what it is about. So now I'll come to the proposed amendment. So in the proposed amendment, the select committee, as you all are aware, that the select committee was appointed and they were to look into the proposed amendments. So very interesting thing in that report, the select committee very recently on 17th of December 2025 submitted their report. So in the report, they observed that considering the suggestions from the stakeholder and deliberations on the same, the committee reckoned that in order to clearly bring out the legislative intent, of allowing sale of one or more assets for maximizing the value of corporate debtor holding multifarious businesses. The definition of resolution plan needs to be extended and made explicit to allow for one or more resolution plans for a corporate debtor undergoing CIRP. Therefore, the committee suggested that the explanation under section 5 subsection 26 should be amended. They stated that the explanation should read that for removal of doubts it is hereby clarified that a resolution plan may include provisions for the restructuring of corporate debtor, including by way of merger, amalgamation and demerger. So this was already there. What is proposed to be added is that and sale of one or more assets of the corporate debtor through one or more plans proposed by one or more resolution applicants, subject to such conditions as may be specified. Now, the very interesting thing to be considered here is that they have given very much a free relaxation, that you can have very multiple, very dynamic scenarios where one or more, any number of assets can be resolved. There may be one plan, more than one plan, one RA, two RA, any number of RAs. There is no restriction on it. The only intent is that there should be a resolution. So, in fact, in the deliberations in the report, if you go through, they have done a very good discussion on this. They clearly indicated that the intent of the code is maximization of value for the stakeholders. And if we restrict that only corporate debtor as a whole should be resolved, then you are not sticking to the principle of value maximization. And for that, they have given this leeway, they have given this wide scope that it is for the RP in consultation with the COC to form a situation where there can be a resolution for asset. And also the interesting thing is that they have put in a condition that they have provided that such conditions as may be specified. So they have given an opportunity that the IBBI can further bring in regulations to deal with the nitty-gritties. As I mentioned previously, highlighted that there are certain points on which the clarity currently is not there. So now with this amendment, if this comes in, we will have a legislative intent. We will have something in the code which indicates that you can go for asset-wise sale, and further then IBBI will be bound to issue clarifications or issue regulations which will deal with the specific problems faced in this asset-wise resolution. So, further, the following recommendations were also made by the committee. They also recommended that necessary regulations to specify the conditions for sale of one or more asset be drafted by IBBI and laid before the Parliament. Further, it was recommended that once a formulation for amending the explanation under clause 3D is finalized, clause 66 be suitably modified in order to amend section 240 that gives the board the power to make regulations. So it is very clear that this is something which the committee was very keen in getting included in the bill. Although this currently is in a stage where still there may be changes, we do not know how this report is implemented by the government and what the final bill will be, which is put forth before the parliament. But I feel that this is a step in a very right direction, wherein there will be a intent in the code which empowers the regulator, that is IBBI, to make in regulations where they think it is necessary to give clarity. So with that, I conclude my presentation on this point, and I thank you all for the patient hearing. So I hope I was able to elaborate and give you a clear picture as to how asset-wise sale is currently being dealt with. Over to you, Gauri ma'am.
Thank you, Advait. And I can see that much pain has been gone into the presentation and the preparation on the subject. And I think that we had got a fair idea of asset-wise resolution in CIRP, and we can also see that this subject is going to be taken up in different ways, either through regulations or through amendments, so that value maximization can be achieved. And now I may ask Namrata ma'am to take up the session for further subject. And we are receiving
Before we go to the further section, Gauri, Advait, can we keep it open for Q&A? I mean,
Yeah, yes, ma'am,
participants, please
definitely.
come ahead and you can ask your questions or we can debate on certain topics. And
Anyone's views
anybody
are
with,
most welcome.
yes.
It has been a very good presentation, Sia Advait, and I hope many people might have queries. So I request participants to put up their queries so that they can be addressed.
Advait, do you have a sample of the Form G of any of the companies having, how do you put it up in the Form G when you are
So, ma'am,
presenting?
as I mentioned that in the Form G context, it was very recently brought in May 2025 that you have an asset-wise, you go for asset-wise in Form G level itself. Previously, in Regulation 36B6A, it was so that once there has been no plan or the plans are found to be not to the COC's liking, then you go for asset-wise sale. So, as such, the Form G is a normal Form G that was published, and in the RFRP, the change was made that in RFRP you put in the IM you distinguish what the assets are that you want to segregated asset that you want to resolve, and in RFRP it was dealt with. But now in Form G it is what they have proposed. I am not aware if any such Form G is published. It may be published, but to my knowledge, it has not happened.
Hi, Advait. Thanks for giving us a view on on assets being sold as individual assets. One quick question to you. Suppose there are some tax credits or deferred tax assets like your income tax or your input credits under GST.
Right.
How would you deal with that? How would that go? Like, just in case if the organization cannot be sold as a going concern, like the example in this case would be like for Seven Hills,
Correct. So, very interesting point that you raised. Even I
where
touched
suppose
upon it.
Vishakhapatnam has the Bombay. Sorry.
Correct, correct. So, very interesting point that you have raised. There will be, I'll make two distinction in what you have asked me. Input tax credit in GST, we'll keep it a bit separate, and income tax, deferred tax asset, or whatever the assets may be there. So, for deferred tax asset, to my knowledge, there is no provision in income tax wherein such identification can be made for specific asset. uh, However, looking into the special case of IBC, in the plan we can seek carry reliefs from Honorable NCLT that these deferred tax asset, because they form a part of the assets which are proposed to be dealt with under the plan. Therefore, beg your pardon. Therefore, relief may be granted to allow these assets to be taken over. How that is dealt with by Honorable NCLT is anyone's guess. It will differ from case to case. With regards to GST, with that is a scenario where you may have a situation, if you like you mentioned that in case of Visakhapatnam and Mumbai, or in our case where there were three separate states in which the units were established. One was Karnataka, one was Chhattisgarh, one was Angul, Odisha. So in such a scenario, you have separate GST registrations for each state. So in that case, it becomes easy that whatever the tax credits are there will be limited to that GST number of that state. The SGST, CGST, IGST will be for that specific GST number. In that case, it becomes easy that you have to claim. Again, it is a relief that you have to seek from Honorable NCLT like we do in other plans, because this is basically a resolution plan which is put forth before Honorable NCLT. But that is the way you can go about seeking relief, wherein you identify the GST number or the GST entity in which the credits are there and seek relief for that. But for direct tax, it is a bit tricky and challenging.
So in that case, would that imply that the carry forward losses or the depreciation may or may not be available?
Yes, so because
And
corporate debtor as a whole has been not
suppose it
taken
was
off.
a case of demerger as you were mentioning, like you said
Pardon, your
section
voice
2.
cracked in between. I couldn't hear you.
I said as there was one of these examples, the one of those illustrations that you gave when section 230 or 232 of
Yes,
the Companies Act was activated for, segregating the assets and selling a part of the
yes,
asset.
yes. So in all the
And
cases, it is demerger is there.
so in that case, would they not be able to take a portion, a part of the credit? Suppose I'm not sure what happened in those cases, but like, would they not be able to carry forward a proportion or a certain ratio? Like you also mentioned that one of these cases, in one of your cases rather, the secured creditors were to receive 70% and the unsecured was supposed to receive 30%. In a
Correct.
similar situation, um, if the tax credits can also be bifurcated in the RFRP, or if it is so.
What I can conclude from her query is that if suppose one of the unit like Bellary or Angul unit is being resolved, so the depreciation or business losses pertaining to that unit or pertaining to that class, can
Or maybe
they
in
be
proportion, because it may
available to
not be
the proposed
possible.
on the proportionate basis to the proposed buyer? Am I correct, ma'am, that this is your query?
Yes,
And
yes.
also, I would like to add one more thing in furtherance to what Gauri ma'am has said, that the first part is how you apportion. That is based on a case to case. The RP has to decide, like based on geography or whatever. And the other part is that, as in case with any other resolution plan, this will form a part of reliefs or concessions sought by you, that the carry forward be allowed. And whether or not that is being granted by Honorable NCLT, that will have to be tested, and that will also again differ on case to case and from NCLT to NCLT.
Right, thank you.
Yeah.
Any further questions, participants?
Just in case, if they were like in these examples, of course, it was a split of not more than one or two organizations. Um, how would the claimants, most of the plans would contain as to how are they actually addressing the payments to various categories of claims. So would that be separate, or would that also be stated in the RFRP as to how, in what proportions the payments would go to various categories of claimants?
So basically, in RFRP, you can state that, but normally, I mean, from my personal experience, what we did is that we segregated the creditors. In our case, it was very much a case that, say, for example, in one unit, there are some vendors, then they were supplying to that specific unit and not other units. So based on that, we were able to segregate the operational creditors, the employees, and so. Maybe certain taxes, statutory dues also were on a state level. Pardon me. As I mentioned, that the GST or state tax, that was on a state level. But then the other creditors, like you have financial creditors, they are not segregated. They have landed to the company as a whole. Or you have some statutory dues, for example, income tax or customs. Now, income tax or customs is never at a unit level, it is at a corporate debtor level, company level. So, now how you segregate that, that is for you as a RP and the COC to decide. You put it in the IM that the total claim is this much, of which we have bifurcated so and so, unit A, B, C, D, whatever, and then that will have to be dealt with in the plan. So, if a resolution applicant is proposing plan for unit A, then he will propose payment to creditors of unit A. Now it is for the COC to decide how the distribution, if that is acceptable, or if any change in distribution is to be proposed or made, that is for the COC to decide. So in the plan, he will say that whatever the claims that you have identified for that unit, I'll make payment of that.
Would you all suppose would the RP also be required to actually segregate this proportion or portion it across the units? Suppose there are 3 units. Will the
Mhm.
RP be expected to, state that the amount out of the amount admitted, the ratio which has been allotted to unit one is one, to unit two is say one, and to unit three is one. The ratios will have to be decided by the RP, do you think, or usually let
So
the plan the course will be decided by the plan alone in terms of what the resolution applicant states in his plan?
For a resolution applicant, it will become very difficult task, and the RA will have very insufficient information as to decide on how the distribution is made, because the RP is having all the claim and the company documents. It is for the RP to specify and the COC. I mean, RP cannot unilaterally take a call. It is for RP to propose to the COC and then the COC to decide about the distribution, that how it will happen in case of other units. If you have plan for one unit, then how creditors of other units are dealt with, that is for the RP and the COC to take a final call on it.
Okay.
Advait, there's one question in the chat box by Mr. Shekhar Sen Gupta. What about the claims of operational creditors, especially the employees' dues if they are involved against all the assets of the CD? How to treat the PF dues? Will it be settled as a whole?
Again, that is a very interesting question. So, as I mentioned, that regarding the distribution and claims, as of now, there is no clarity in any regulation or any provision. In all the cases that have taken up, that have been resolved so far, the RP in consultation of the COC have discussed and taken a final call on the distribution. Regarding this specific query, if there are some employee dues which are for all the assets, then there may be a scenario where some part of the claim is being paid off. Maybe you have some worked out some formula where for asset A you have allocated some percentage, that if asset A is resolved, that much percent of your claim will be dealt with. So remaining percent will still continue, and as and when those specific assets are realized, that amount will be realized. But again, this is all conjecture, or this is all what is being done based on understanding. There is no, as such, any regulation or any judicial precedent for this.
Thank you. Thank you so much. Any further questions?
Yeah, I have one question regarding the valuation. See, maybe on the discussion paper, it is now been proposed there will be around only one valuer for so there is some sizes given 500 crores. So whether now in looking at this, whether asset class or maybe individual can be done by the same valuer. So in that case, there will be no difference in the valuation perspective. So the same valuer which has been appointed, can we be given that he will only value individual asset also and give the corporate data as a whole also?
Sir, as such, even now there is no provision for valuing individual assets. What we have done is that taken the valuation report, and in the valuation report there is a line wise or whatever the bifurcation is given. Based on that, we have assigned value for the assets which we have identified. To my knowledge, there is no provision for valuing assets independently or individually as identified by the COC. Valuation is currently also done at the corporate debtor level. It is only that when you identify the asset later on, you are assigning the value based on the valuation report. Regarding how it will happen in after the amendment comes in regarding single valuer or so, that I think will follow the similar process, that the valuer will submit for corporate debtor as a whole, and when you identify the asset, you will assign the value based on the valuation report. Maybe once this proposal of the standing committee is admitted, maybe IBBI will come in with more clarifications or more regulations on this, how to deal with this situation. Then we can have more clarity on that.
Okay.
Yes, just to add to this, in the proposed amendment, they are also talking about the claim of the creditor to remain secured to the extent of the value of the security as per the valuation report. So that new clarity is going to create a lot of issues simultaneously, because in case of, say, unit which is not running, say, 4 years, you have a term lender, you have working capital lender, and the working capital lender's assets might not be there. So the security assigned to them might be zero, and the term lender may have a higher security value. So these issues, along with the asset wise, or as I would say sector wise resolution, is going to be a challenge. To add to what Mr. Modilal Pamecha suggested and Advait explained, these issues are going to come up and they need to be addressed beforehand. Otherwise, it will entail a lot of litigation, which will, instead of easing the things, it will complicate the things and more litigations will be there. So, yes.
So, with this, I think we can come to our next session, and we request Advait to stay with us up to the end. I hope that'll be okay, right, Advait?
It will be my
Actually, let
pleasure.
us felicitate Advait, because I am an insider and he is our guest. So let us felicitate Advait right
Right
now.
now. So, I request Dharaj Patwardhan sir to please present a memento to Advait.
Yes. So Advait, Dharav, thank you for being here. It was a fantastic and very well made presentation, and you answered almost everybody's queries. And this topic is going to be there in weed out any impurities in the company, and only the real value will come out for sale maybe. So this is going to be an important topic going in future, and your presentation will certainly be a help for everybody to refer back to. So thank you, Sri Advait Dhara, for being a speaker today on the webinar held on 20th of December, being presented to you with gratitude by Dr. Ashish Makija, President of IPNet, and from all of us here. The virtual memento, please receive this. The physical memento will be sent across to your office in due course. Thank you
Thank
very
you, sir.
much.
It was an honor to give the presentation. Thank you.
Thank you.
Thank you. Thank you so much, Advait, for helping out today. And everybody's requesting for the copy of the presentation. It was a truly interesting and enlightening webinar. And thank you so much for coming out today for the webinar. With this, we come to the second session. I request Udaraj Patwardhan sir, please share and enlighten us on the key recommendations of the winter session takeaways that we call.
Thank you. Thank you. Thank you very much. I would not take much of time. I will take about 15-20 minutes to touch upon some 10-12 recommendations that have come up in the winter session from the select committee. Now, on the lighter side, there was more hype of discussions with the committee rather than the final output. I can see that not much in the amended law has changed. There are some critical suggestions by the select committee, which we hope they will be accommodated in the final version, which will be put up in the next session, that is the budget session. And a lot of insolvency professionals and stakeholders contributed, presented themselves before the select committee, and have given a lot of inputs, and they have been considered also very positively. So I see that during the course of last 8 years of insolvency law, this process has been the most participative process that I have seen. So with that background, let us have a quick look at what, or a bird's eye view of what was there in the amendment law first. And then we will look at what further has been suggested by the select committee. So I will run through a very quick presentation about what was there in the amendment bill that was presented. So I will share that on the screen. Somebody can make me a co-host. I need to share. Yes, thank you. So the amendment bill analysis. So the purpose of the code and the need for amendments, let us not go through it again. We will save some time on that. So what has been done is this amendment bill 2025 has 52 clauses and it has 36 plus amended sections. 9 sections have been completely deleted. So net we have 16 sections new added and the net gain is 7 sections accordingly. And 2 new frameworks are apparently exclusively added. The creditor initiated insolvency process and group insolvency. And they have also touched upon cross-boundary insolvency, but it's only an enabling provision in the code, and not much has been discussed there. So what are the changes that were proposed? And out of these changes, some of the changes have been further modified by the select committee as a recommendation. So the explanation has been added to the definition of security interest, section 331, in which you are aware that only those security interests which are created by contract will now be there, and those who that are by way of operation of law won't be a security interest anymore. Service provider definition has been added 331A, in which again select committee has suggested that registered valuers should be added to it. Avoidance transactions, a new definition, and fraudulent transactions, a new definition. We already are working on it. However, they have been grouped. 43, 50, and 43, 45, and 50 have been grouped together in avoidance transaction, and the 66 wrongful trading, fraudulent trading has been now called as fraudulent transactions. New definition of initiation date has been added so that we get a more look back period. Resolution plan has been expanded, sale of assets has been added, and C. Advait Dharab discussed this in details. And voting share, again, related parties won't be included in the voting share, and that is what we are following even now. AA duties provisos have been deleted. If there are any delays in approval of or initiation of insolvency under section 7, 9, and 10, then in that case, the reasons will be required to be recorded. The bar under section 7 has been extended to CIRP also, and very major change in section 12A, in which withdrawal framework is now very restricted. It can be done only after COC is constituted and before Form G is published. So only within that period it is possible. Moratorium gets extended to guarantors. Guarantors cannot take action against the company if they are trying to do it during the moratorium, and if they are trying to execute their power of subrogation. First, the power of subrogation is taken away, and second, they cannot take any action during moratorium also, both done simultaneously. IRP appointment rules are changed, and IRP now will be verifying the claims. Previously, it was only collating claims, now it is verifying claims also. The obligations under section 19 have been extended to persons to include contractual persons. Also, previous employees, previous directors, promoters, everybody has been included. Them. CC will supervise the liquidation as per amendment in section 21, subsection 11. Deemed RP appointment, don't have to discuss it further. RP's duty to file wrongful trading, specifically discuss RP, it will continue. It has been done like that the past, now it is expressed as a part of the code. And these which are held as a mortgage or otherwise secured with any creditor, the permission of that creditor and of the concerned COC, those can be included in a plan. However, the proceeds will go only to that creditor. So that is a very critical amendment. Others cannot share that pie. So that is a very critical amendment. Under Section 3, dissenting creditors take away has been amended. They will be able to take up only the liquidation value or plan value, whichever is lower, that will go to them. Under Section 31, split approval of the plan is possible, wherein the SRA can be handed over the assets and the CD, and the amount will be deposited, resolution proceeds will be deposited in a escrow account, and then the litigation between the lender continue. Of course, COC approval is required for that. This will be very useful where there is a inter-creditor litigation, especially from minority creditors. In liquidation, there is a quick overall. The CIRP revival is mandatory before liquidation. So that is one option. I'm not going to details of timeline, etc. I'm just highlighting what is there. Otherwise, this only will be a lecture for 2 hours. We don't want to do that. Then COC's power to nominate liquidator has been asserted because we have seen that many NCLTs were not appointing the COC nominated liquidator. The liquidator can be replaced by the COC. The duties of the liquidator have been expanded and liquidation estate has been expanded. Verification of claim under liquidation is not required now. The claims under CIRP will continue. Section 32 to 42, 38 to 42 have been deleted. Preferential transactions period is now clarified. It will now include the period from the initiation date till commencement date. So that period has been now added. So this is a new amendment and that will apply to 43, 46, 47, 49, 50 as well as to 66 also. In distribution waterfall, clarifications have come in that the secured creditors will have right to the security to the extent the value of security is. This is very critical. So the security may not be shared on pari passu basis, one, and whatever is not secured will fall as unsecured. So these are very critical amendments. Let us see how creditors will take it up. The dissolution period is capped at 180 plus 90 days. There won't be that might not be possible, but let us see how we will be able to do it. Two new frameworks have been introduced: CIIRP and group insolvency. For CIIRP, section 58A to 58K have been introduced. It can be triggered by creditors. The time limit is 150 days for 45 days extension. In this, moratorium is not automatic. For moratorium, the RP can go and seek moratorium. So any action against the company will not be stalled. It will continue and the board of directors will continue to function while the RP will have a veto in the meetings. In group insolvency, section 659 9A has been added, and as you are aware, there are two types of insolvency processes in group insolvency. On major level, one is cross-border and domestic. So they are talking about domestic only at present. And within those domestic and cross-border, the ways it can be conducted is procedural coordination and substantive consolidation. They are talking about only procedural coordination at present. We don't have time to discuss that at present, but just highlighting it. Penalties have been revamped. I am skipping this slide. Personal guarantees is very critical. Section 96, automatic moratorium when you file the application under 96 will not be applicable to personal guarantors who are guarantors to a CD. So this protection that they used to enjoy is no longer there. RP report period extended to 21 days. If there is no repayment plan, it is absent, then automatically it can go to bankruptcy. Report time under 121 has been doubled to 14 days. Bankruptcy processes, there has been small tweaks and a new section of undervalued transaction has been added, 164A. So if I do it overall, CIRP, two new sections, 7, 31 and 28A. Each section from 7 to 20, 31 is possibly touched upon. New definitions are there under section 3 and section 5, and in liquidation, again, most of the sections from 32 to 54 are touched upon, and new section 34A has been introduced. The new frameworks, two new frameworks, CIIRP, and along with that, group insolvency has been added, personal insolvency, again touched upon, and as you see, initiation to resolution touched. So that is how they have done this whole process. Now let us see what has been suggested to be amended in this by the select committee. We are not going to discuss what they found all right. We will only discuss what they found needs modification. So we will go there now. I will be discussing that briefly in next 10 minutes, and I think that is it. Thank you. So we were talking about the definition of service provider. So the select committee has come out with their opinion. Just let me go to that. I hope you have the copies. I'm not sharing it on the screen. So they say that the service provider definition of 331 has to include a registered valuer. So this is a new amendment that they have suggested. So what they say that service provider definition as given in clause 2b stated that the new definition laudably groups core regulated entities, IPs, IPAs, IUs, etc., and provides a mechanism to notify the new ones. However, it conspicuously omits two key entities that are already part of the ecosystem and regulated, recognized by IBBI. So they have suggested two very critical, registered valuers and IPEs, and any other professional as may be specified. So they want to keep it open for one, registered valuers, second, IPEs, and tomorrow if somebody talks about say transaction auditors or any other professionals which are introduced say for 29A verification, say they want to keep it open, so they say any other professional as may be specified by the government or by IBBI. So this omission creates ambiguity, they say, as to whether general rules or disciplinary provisions for service provider will be applied to them. So they are suggesting that in clause 31 section 3, they want explanation to be added in which these service providers can be added. So this is the first amendment that they have proposed. I will go to the next one now. The next one they have suggested is a constitution of monitoring committee under section 32D may be codified within the statute itself to ensure transparency. So this is something which has been very critically observed by them. So I will go to that particular suggestions given by the committee. Allow me a minute, please. So what they're suggesting is they should add one clause D that it provides for implementation and supervision of a resolution plan and provides for constitution of a committee for the purpose subject to such conditions and in such manner as may be specified. So the monitoring committee, which was not codified, it was only suggested. So they say that you include that specifically in section 30, subsection 2, subclause D. So this is one more amendment. Regarding the clean slate the provisions, they say that the committee recommends that the declaratory nature of the clean slate provisions must be amplified to clarify to prevent unnecessary litigation and recommendations, and they recommended an explanation to clause 19. So let us see what they have proposed. Allow me a minute, please. So in clause 31.4, they have provided certain amendments, and the clean slate principle, they have suggested clause 19A may be introduced, in which the clean slate principle can be taken up by way of an amendment, and the provisions against any claims, any civil claims against the corporate debtors will go away. So they have suggested that explanation may be added accordingly, and it will help more clarity on the clean slate principle. The third one that is proposed is the revision of provisions of section 34 of the proposed bill to reflect that the IP who has conducted the CIRP or PPIRP for the CD shall be ineligible to be appointed as the liquidator. So this is something which goes against the discussion that we had. So let us see as to what gets accepted by the government while putting up the bill. The committee also proposed that section 61 may be amended to introduce new clause 42A. Now let us see what they are suggesting by the new clause 42A. So in clause 42A, they want to add a timeline of 3 months for disposal of appeal for NCLAT. So this is a very aspiring kind of an amendment they want to propose, but let us see, because they might have observed a lot of delays or pendency at NCLAT level. So what they are suggesting it in the section 61, in which it is provided that the appeal from orders from NCLT will lie with NCLAT, they are suggesting that the NCLAT shall dispose of the appeal within a period of 3 months from the date of receipt. So a new clause 42A is being proposed for that. Then the committee recommended that section 74 and 76 be decriminalized and substituted with new civil penalty provisions, which is they are suggesting two new clauses. 67B is punishment for contravention of moratorium and the resolution plan, and clause 67C, which is for a punishment of non-disclosure of dispute or payment of debt by the OC. This is something that has been proposed because they have an observation that criminalizing those sections may not actually be taking effect, because a section which is criminalized takes its own time to get adjudicated, and somebody may not even be put to justice in such a case. In case of civil penalties, it will be easier to bring somebody to justice, put up the penalties, and go ahead with that. So that is something which is proposed. And then in section 196(1), they have proposed modifications in clause SA, and the new clause SA is proposed to be read as it would specify the standards of conduct of COC and its members, including the period within which COC shall take decisions while acting under Part 2 and 3 of the code, as the case may be. So this is a very specific amendment which is proposed, that how COC will behave, how they will take decisions, and there will be a standards of conduct. So they will be required to abide by it. In section 240C of the Act, the provisions of cross-border insolvency are to include the process of recognition of proceedings, granting relief, judicial cooperation, assistance, coordination in connection with the proceedings for such class, etc., outside India. So they say that they should be initiating it earlier than keeping it on a back burner. So in case of cross-border insolvency, the resolution professional of a cross-border jurisdiction can come to NCLT here, which will have a a specific designated NCLT where the RP of a foreign insolvency or liquidation process can go, seek a recognition of the proceeding, seek some reliefs, and there will be judicial cooperation between NCLTs also. So these are the recommendations in brief of the select committee, and let us hope they will be appropriately taken on record, and the bill will be amended appropriately. So this is it from my side, overview of both the code which is proposed to be amended and also the brief recommendations, only to the extent they are deviating from the bill, because the committee has discussed each clause and have commented upon the sufficiency of that clause. So that we are not going to discuss today. So with this, we come to the end of my brief address to you all. Thank you very much.
Thank you so much, sir, for the brief key recommendation of the winter session. And it is my pleasure now to just announce that next week IPNet South will be holding its webinar. We look forward to all the active participation yet again, and it will be circulated. The topic will be circulated in due course. With this, I thank everybody for being present today and request Darad sir to please also give the vote of thanks, sir.
Thank you. So I of course will not be thanking myself, but I will thank Namrata and Gauri personally, because they single-handedly ran this particular webinar today. Gauri approached Mr. Dharap for this different subject, and was very instrumental in deciding the subject and putting it up before us, though it was quite different from the normal practice that we do. So thank you everybody. Thank you all the participants for joining here now. And back to you, Namrata. Thank you.
So we'd just like to thank everybody and looking forward for more sessions together. And we'll see you all next week on Saturday, 4 to 6.